You are listening to chartingwealth.com for Thursday, the 17th of May, 2018. Don't forget, friends, we do have Charting Your Way to Wealth, our book available for sale. It is just rolling off the shelves, and we appreciate everybody supporting us. You can find it at the website under the daily market reviews we post every day. There are links there where you can go online and purchase our book. We would so appreciate it. Every dollar that comes in goes, of course, to support our work and all we do. We've been providing this to you for several years now at no cost, and we plan to continue to do so. But your purchases of our books and, of course, our trader journals would be most appreciated. Let's keep pushing through these charts. We see stocks are up for the day, both the S&P 500 and the NASDAQ 100 as represented by QQQ. We also see that bonds are down. Gold is down. Let's jump first into the S&P 500. We're going into the second week of open box green candle up movement. Remember, open box green candles are strong up movement. Solid red down candles, strong down movement. We've seen the market slide sideways over I guess really since the market really dropped for 3 weeks in a row on the 23rd of March, the week ending the week ending the 29th of March, and the week ending the 6th of April. Then we saw the market really go into a sideways slide, popped up 1 week, but pretty much spinning top and dojis. And then over the course of the past, so far this week and the prior week ending the 11th of May, we saw strong up movement in the market, not strong enough yet to cross over going up. Derivative oscillators continuing to lose energy on the weekly chart and downward energy. And we see that the price percent oscillator is getting closer to crossing over going up. Will that happen by the end of the week? We have 2 days left of the 5-day candle. Don't know. We shall see what we shall see. We look at the 2-day candle. We had 3 strong candles coming into this latest one that just finished drawing. It is a red open box candle. Again, it shows slowing down movement, but it is not a solid red candle. In fact, it doesn't appear to have a wick on the bottom, just a wick on top. It is a bit of a pullback, but price movement is still above the 2-day trend line. Price percent oscillator still heading up. Derivative oscillator still gaining upward momentum. As we look at the 4-hour chart, we can see what slowed everything down. The market really topped off back in the morning on Monday the 14th, slid sideways that afternoon, down on Tuesday, and then Wednesday up a little bit, up a little in the morning, up more in the afternoon. However, the derivative oscillator, and again, remember, oscillators are the energy of moves accentuate things on the oscillator. And what happened was there was some up movement, but not strong enough as far as the prior down movement, particularly the strong down movement on Tuesday in the morning and afternoon. And what happened is it continued to push that oscillator over. So the derivative oscillator is gaining downward momentum and has switched over, actually did in the morning on Wednesday. And the price percent oscillator looks like it's heading toward a crossing over going down. Hasn't done that yet, so we'll keep our eye on things. The big takeaway from the S&P 500 is, of course, still in a confirmed down move on the weekly chart, confirmed up move on the 2-day chart. We'll see how the week finishes off and if there's going to be enough of movement to cause a crossover going up. Now, from the S&P 500, we go to QQQ, which is the NASDAQ 100, going to the 3rd week of up movement, closer to crossing over going up than the S&P 500 is. We see that on the Qs. Derivative oscillator is losing downward momentum. Price percent oscillator getting quite close to crossing over going up. On the 2-day chart, we see again a bit of a pullback, more indecision here on this candle. Again, stopped right there on the 2-day trend line, hasn't penetrated that. It's a red open box candle. Does have a wick on the bottom, unlike we saw in the S&P 500, and a wick on top means indecision, of course, tending down. Price percent oscillator still gaining some momentum. Derivative oscillator is gained some momentum. Price percent oscillator still going up, not as fast as it had been, but still still increasing upward. Let's see what we see on that 4-hour chart. We saw the same dip on Tuesday, and again, that increase, stronger increase in the afternoon. Of course, the derivative oscillator flipped over 4 hours earlier, actually in the afternoon on Tuesday versus the morning on Wednesday, as did the S&P 500. Stronger down movement actually on Wednesday we saw. So we'll continue to keep our eye on things. We also saw, of course, the 4-hour chart rotate over in the afternoon on Tuesday. And derivative oscillator gaining downward momentum, price percent oscillator heading down at the same angle. So we'll keep our eye on things and see if there's enough movement by the end of the week to cause a crossover going up on that weekly chart. Of course, if it does so on the S&P or the Qs, it would give us the opportunity to jump in that following Monday at 10:30 a.m. after idiot hour is over if the market calms down and is on an upward trajectory. We'll keep you posted and let you know what we see, particularly those of you who subscribe to our texting service here in the U.S. Of course, you can text the words Charting Wealth, that's actually one big word, Charting Wealth, our name, to the number 33222. That's 33222. All the instructions are there for everyone who subscribes to the newsletter. Subscriptions, of course, are for free. You can go to chartingwealth.com, put in your email address and your name, and boom, you'll receive all that we have to offer, and that is links to everything from the discounted service we have available to you from freestockcharts.com and TC2000, which is actually what you see on the videos. It is the charting software that we use. Links to the book, Charting Your Way to Wealth, just published and sending out copies every day. And in addition to that, our Trader Journal. Let's keep pushing through these charts. We go to 20-year bonds. Down for the day. We see again that we are looking at the weekly chart, trying its best to cross over going down. Looks like it's probably going to happen this week. It is already showing a pretty strong crossover, derivative oscillator gaining downward momentum. In the past, when it looked like we were trying to cross over going down, the derivative oscillator wasn't cooperating and we just slid sideways, almost laminating the red signal line. Well, it looks like we're probably going to get a crossover unless something wild happens and bonds just go through the roof. So we do see a red candle forming for the week. No up movement on that. A long down wick about the same width as the candle so far. I'm sorry, same length as the candle so far. So we'll keep our eye on things. Derivative oscillator gaining momentum. Price percent oscillator getting actually continuing to spike down. We look at the 2-day chart. What do we see? We see a big red down candle and derivative oscillator gaining momentum from the prior 2-day candle, and that price percent oscillator really spiking down. And then what do we see on the 4-hour chart? It, of course, has been really hammering down since a big drop on Tuesday morning, Tuesday afternoon, bit of an uptick in the morning on Wednesday, and then a strong move down in the afternoon. So derivative oscillator gaining downward momentum, price percent oscillator heading down. Again, what are we watching for? Well, we're looking to see if indeed we lock in this weekly vertical crossover by the end of the week going down, and for a jumping in point, own bonds going down on Monday at 10:30 as per our standard procedure. Of course, all of our trading techniques are covered in our book, Charting Your Way to Wealth. Please get a copy of that. It'll cue you in on all the stuff we do here. And again, they are available at the website and at our YouTube channel. You'll see links there and in the email that all of you get. Lastly, we go to gold. What is gold doing? Well, gold crossed over going down all the way back on the 16th of March. Then it pretty much went up after that. And we saw no crossover on the red signal line, though, just not enough energy there. And then gold started hammering down starting on the 27th of April, and has continued to move down on that weekly chart. Had a bit of a bump up on the prior week ending the 11th, but not enough to push through the weekly trend line. Things just continued to move down. Price percent oscillators actually popped down at an even harder angle. Derivative oscillator gaining downward momentum. As we look at the 2-day chart, what do we see? The biggest down candle we've seen in quite a while on the 2-day chart for this latest big down move. Gold really spiking down. Derivative oscillator gaining downward momentum after it had been losing it. And the price percent oscillator cranking over, going down. And what do we see going on our 4-hour chart? Well, remember, we said watch that 4-hour chart. It's been in a pullback for quite a while, even though our weekly and 2-day are in down moves. It's our classic way of jumping in, other than the method we have for jumping in at 10:30 following a weekly vertical crossover. This one is where we already had a weekly vertical. We have the 2-day also moving in the same direction as the weekly trend, and we have a pullback on the 4-hour chart, which we had starting on May the 4th. And of course, once that ended on the morning of Tuesday, May the 15th, we had that jumping in point in the afternoon. And of course, we see it continuing to head down. Bit of a pullback during the end of the day, but gold down 0.16%. Keep your powder dry. Continue to watch this in gold. See how long you can stay in for a successful virtual trade. And again, this is the hardest, sloppiest time of year to try to trade. Sell in May and go away is that adage we talk about over and over again, and we'll keep saying it. Why? So much of the volume goes out of the market. Big money can leave. Volume can really be reduced, and you can see a lot of oscillations during this time of year. When it gets hot, things in the market can get sloppy. So again, we're waiting for that fall-winter trading zone when it comes back, but in the meantime, we're going to practice, because that's how you get to Carnegie Hall. Practice. Keep practicing hard, my friends. God bless. All the best from the whole team here at Charting Wealth World Headquarters.